Good afternoon everybody and welcome to our Academy Forum. Nice to be doing it in person. Obviously our last one was back in February, which we did online. And hopefully the new venue was easy enough for everybody to find. And we've got the sun, so you can have a look at a pitch at lunchtime. Welcome. For those that don't know me, I'm Michaela Johns, one of the directors at Williams & Bell, and I head up the Academy's team. I think I know most of you now, and then many new faces coming as well though. So we're in a strange period at this moment in time of what's officially known as PERDA. That's that 6 weeks of sensitivity, of which the government will not release any documents that might be politically sensitive. And hence that means, for all of us in particular in the room, that we won't see the Academy financial handbook until after that period. So a little bit later than we would normally see it in normal years, but we would expect it after that period of time. So just running through the agenda very briefly so you know what's coming up. We'll have Alan, who will be covering our leasing update. And then Gary will cover the External Auditors Forum feedback. Matt will cover the changes in the Academy Accounts direction. And then we have an external speaker here today, Victoria from Laytons, a firm of solicitors, who will cover things to watch out for if you are considering employing teachers from overseas. I know there's a lot of you who've got skills gaps, like we do in our profession as well, and people are turning to overseas recruitment. So it's just trying to point out any tips and hints in that area. And then we'll move on to Alan, again, who will cover the budget forecast return, which I think many of you are quite interested in, about assumptions and things. And then again, we have another external speaker, Ian, who's sat to the side for us, who's going to cover any investment opportunities and things to think about in that area, and he was recommended by Davies from UTC, so nice to have a recommendation from in the room. But otherwise, I shall hand over to Alan.
Thanks, Michaela. Okay. Good afternoon, everyone. I know some of you might usually expect it to be a bit doom and gloom from your auditors, but today we're bringing you some good news, hopefully. We've had some recent simplifications in respect of leases that have been prompted by a new international accounting standard. Just as a bit of background to lease accounting, we've had two treatments. Operating leases are typically for assets that are held for a short period of time, and they are held off the balance sheet with the rentals going through the expenditure. And on the other hand, we've got finance leases which are on the balance sheet with a asset included within fixed assets, recognising the right to use that leased asset, a liability also on the balance sheet reflecting the future rentals that have to be paid. The payments that are made reduce the liability, and the asset is depreciated over its useful life. So two very different treatments. But the new international accounting standard will mean that most leases will be treated as finance leases on the balance sheet rather than operating leases. So it's going to be a bit more clear-cut and less of a judgmental classification. There are some exceptions. Short-term leases, that's where the term is less than 12 months, will stay off the balance sheet, and also low-value leases as well. We haven't had a great deal of guidance on what low-value leases are, but specifically excluded are any vehicles and any property, so they'll never be classed as low-value, and we're expecting some more guidance in that respect shortly. Now, this new international accounting standard doesn't affect Academy accounts at the moment, because the date of the UK implementation isn't yet confirmed, and we're currently expecting that the effective date will not be before the 1st of January 2026, and for academies that will mean that this accounting treatment won't take effect until your August 27 year end, so it's still a little bit down the line. Now, some of you're probably thinking, sounds quite complicated, where's the good news? Well, even though this doesn't yet affect our academy accounts, the ESFA have simplified the requirements in respect of approval. Under the financial handbook, Academy Trust Handbook now, trusts are required to seek consent from the ESFA for taking out any borrowing, and finance leases have always been classed as a form of borrowing. So any academy seeking to take out a lease that was classified as a finance lease have been required to obtain consent from the ESFA in advance of taking out a lease. And the ESFA generally haven't really given their approval to that sort of borrowing. So it's meant that these leases have been generally sort of dead ends for academy trusts, or have caused issues with compliance with the Academy Trust Handbook. And over recent years we've had to qualify some of our regularity reports in respect of academies that have quite often unknowingly taken out finance leases. So these changes mean that from the 1st of September this year, the ESFA have granted effectively prior consent to certain types of leased assets. And they've published a list of assets where no prior approval was needed, and it's actually quite a wide-ranging list. And there's IT equipment such as computers, printers, photocopiers, servers, whiteboards, touchscreen boards. And we've got telephone equipment, and mobile phones, landlines and other telephone systems. I know some academies have had issues with taking out, for example, a tablet on a mobile phone contract, that type of thing, because it will ultimately end up being their own asset, so that will simplify that. Catering or cleaning equipment, and this is an area where we've had lots of issues in the past to do with what's known as embedded leases that are within catering contracts that we've covered at the forum previously. So this is going to considerably simplify that area, and that covers tills, water coolers, vending machines, and a very wide variety of catering equipment. It covers furniture, bathroom sanitary equipment, gym equipment, things to do with groundskeeping, such as lawn mowers, vehicles such as minibuses are included, and also temporary classrooms and other similar temporary structures. There's also LED lighting systems included, or assets that support renewable activity, but that only applies where those that are sourced through the DFEs get helpline from the school's website, or are a recommended route from the Find a Framework website. And the good news is that this also covers existing leases that are in place before the 1st of September for any item that is included on that list. So like I say, it's very widely drafted, does cover a lot of problem areas, not only the catering equipment, but also IT equipment, where we have run into issues as well previously, as IT assets can be quite short lives and can end up getting classed as finance leases, because the academy might typically use an asset for most of its useful life. So glad to be able to kick off on a positive note.
Afternoon, everybody. So a couple of slides in respect of the External Auditors Forum. So for those that don't know, the External Auditors Forum is an online meeting between about 100 or so auditors and the ESFA, a couple of representatives from the ESFA. They try to hold it quarterly, potentially, if possible. The prior one to this was July 23. They did try and hold one in December, but for natural reasons we were very busy, so a lot of auditors staying for none. So the last forum was on the 23rd of April. So post all the audit assurance work was done for 2023. So up on the slide you can see that I will read out some because some of the wording is a little bit small. We had feedback from the SFA on what they were seeing in terms of reporting that was coming through from them. So in terms of filings, there was a general, that's the top right hand pie chart there. There was a general feeling that things were getting worse in terms of how quickly, how many reports weren't filed on time by the 31st December deadline. So 95% were, 5% weren't filed for the deadline. There's still, as at the 23rd of April, so the last forum, there was still 16 that still hadn't been filed. So various reasons, I'm assuming, maybe going concern issues, maybe pension issues, reason why they weren't filed. Not on that slide, but they did also say at the same time there was 352 trusts that did not meet the 15th of March deadline for the school resource management checklist as well. So quite a high proportion didn't meet that deadline. We then also got reporting on audit opinions. So audit opinions are the bottom left hand bar charts. So I think the writing is quite small there. So reporting on 4 different types of modifications. So emphasis of matter, so perhaps where something needs drawing attention in the account, it's not a qualification. Tier uncertainty, so perhaps it's going concern issues, but there's some uncertainty whether that is an issue or not. Basis other than going concern, which is the third one along, so perhaps there's some concern as to whether the trust is a going concern or whether the accounts need to be drawn up on a breakup basis instead. The fourth one is a qualification, where they just didn't agree with what was in the trust account, so they qualified the audit report. So you can see that the left hand, the bluey-green one is the current year, and the red one is the previous year. So a lot more emphasis in matters. So this is primarily to do with pension schemes, the fact that some trusts start to realise assets, so that's what the actuary's report is showing them. So perhaps just drawing attention to the fact that the trust has recognised that asset. On the far right, qualifications again, primarily into the LGPS, perhaps where there's a disagreement as to whether an asset or liability should be recognised. So about more than 10% really of the audit reports that are going in have some kind of modification. It's quite interesting. Regularity, so also requires a report on regularity points as part of our work. So exceptions, bottom right hand chart, so that actually went down. So it got down from 209 to 184. No real reason for that, perhaps just is what it is, I think. And then, but on the regularity management letter points, there were 307 trusts that had high priority risks included on their audit findings report. Possibly more importantly, though, as well, there's 914 risks that weren't being dealt with in previous years. One thing the SFA always looking for is to make sure that those risks are being dealt with in a timely manner. So just not on there, but the average number of items that appear on a management letter point has increased as well. It's gone up from about 3.8 to 4, so minimal increase, but still shows that perhaps some of those risks are just being repeated and the number of risks is just increasing. So that's a summary of what the SFA reported back just in terms of the 23 year. There's a few other subjects which we touched on the 23rd of April. Matt will cover more on this in his presentation on the accounts direction. But as I touched on the previous slide, one thing they wanted to emphasise was that addressing of those risks and clearing them. So they've now included a section in the annex to the AAD about making sure that due attention is given to those high risks and to carry forward risks to make sure that they are cleared. We've been trying to campaign with the ESFA to try and get them to give us more clarity as to what goes on the management letter point versus what goes on the exception, but they're not very keen on giving that guidance, so that was their sort of halfway offering to the auditors. We've also called in the past for a closer alignment of actuaries and auditors, understanding what each profession does. It's a bit of a dark art, I think, what actuaries do. So one thing the ICAW commissions, ICAW is our regulatory body, is to prepare an informer document which is aimed at auditors but also aimed at employers. So it will be a useful document for your trustees or anybody employed at your trusts. And the basis of this informer document is to give you enough information that you can interpret the data, you can understand what the actuaries are doing. So you can, when you get those reports at year end, you can understand them. So the draft of the informer document came out last week. It's about 50 pages long. So we haven't looked at it as yet, but it's something which we will circulate as and when we've had a look at it, and it's the final draft. So that'll be coming out soon. We also had a presentation from a chap called Stephen Graham, who is the face counter, part of counter fraud team. He just wanted to give us an overview of sort of the 5 highest level frauds that they're seeing that come into the SFAs. Number 1 was bank mandates. So he was saying that a lot of fraud actually takes place quite early, so contact details being changed as to who the bank should contact in the event of a bank mandate request chain. So they're almost lining that up for a future fraud. So it might be something you might want to check who your contact details are should the bank mandate need to be changed. Phishing emails was number 2. One thing we do at HWB is on a weekly basis we get fake phishing emails coming around from our IT team. So catches a lot of us out, unfortunately. So it's something, it might be something you might want to consider. It's certainly alerted us to be a lot better in terms of spotting those. Abusive position number 3, so related party transactions which really shouldn't be going through the trust. Number 4, misappropriation of assets and funds. So anything where assets are at risk or funds are at risk, you just want to make sure that your processes at the watertight. The final one was linked to that with inflation of numbers, linked to securing additional funds as well, so something which they do get reports on. And one of the forum members also raised an example question which I thought may come up in the future. It's helped to one trust and Grace. So they had the situation where the accounting officer was going off on long-term sickness. Who do they put in place to cover that long-term sickness? So there's a couple of thoughts from the floor. So the first one was next highest member of the senior management team. Actually, the more consensus was actually the CFO would be better placed just because their understanding of the regularity side of things. However, the ESFA then chimed in and said, well, actually, be careful here, because the CFA has got responsibilities here. You've got to create a clear delineation between the CFO, what they can do, and what they're going to do as an accounting officer. So those two cannot cross. So if you're going to go down that route, the CFO cannot step back into their CFO role. So what they did say though was that pick the phone up to them, talk through the situation, explain the roles, explain who you've got to cover those roles, and they can guide you on that. But just be careful that you don't cross over CFA role and accounting officer. And the final thing, Michaela touched on it earlier, the accounting officer letter came out 29th of May. Make sure your clerks just circulated that to board trustees and to the accounting officer, of course. A couple of things it mentions there. One is the election on the 4th of July. As Michaela said, things are on hold apart from standard things. So things like the trust handbook won't be announced until after the election. Any questions at all on those slides? Over to Matt, the AED.
Yep, lovely. Cheers, Gary. Yeah, so as with all New Year's, the Accounts Direction was published on the 27th of March this year. So slightly earlier than last year, definitely earlier than it has been in previous years. So obviously it relates to current academic year ending 31st of August. I'm sure everyone is aware, kind of it relates to basically the requirements of academy trusts in terms of the financial statements, basically. So today, just going to be going through the updates on this year's edition, both in terms of the financial statement areas, a couple of disclosures which have been added, and then also the other matters which have been added this year. All fairly minor, in my opinion, but important to take into account nevertheless. So, starting with the financial statements side, so you can see core 16 to 19 funding disclosure. So they put like a little extra bit of guidance in there in terms of the requirement to separately disclose material non-GAG ESFA grants, which includes this 16 to 19 education funding. So if this is relevant to yourselves, then what would be quite helpful is if, if it's coded to like a separate normal code or cost centre, we can basically pick that up at year end and ensure it's disclosed correctly in the accounts. And that will be both current year and prior year for disclosure as well. Similarly, number 2, for the disclosure on other employee benefits. So they've added clarification that within the staff costs section of the accounts, then again, any costs relating to other employee benefits have to be separately disclosed in that note. So what they mean by other employee benefits, it's to do with non-monetary benefits, and it can include things like medical care, housing, cars, and then kind of free or subsidised goods or services for current employees. So again, if any of those sorts of transactions relate to you, then again, except for normal code or cost centre, then they can basically be analysed out and disclosed correctly. Thirdly, to do with lease types. So most schools that convert to academy status continue to occupy the premises which they are on the previous school on a long-term basis, but do not apply a freehold. So in that instance, we kind of have to recognise a value to recognise it as an asset within the accounts. So that's something which we've discussed as relevant with you before, where needed. But what the AED has done this year is they've clarified what's required in the accounting standards in order to give a few options as to how to get that valuation.
My firm is a City of London firm, so we're a full-service law firm based in near Liverpool Street in London, but we'll be moving very soon to new offices, and there will be a party, which we're very excited about. So when Michaela and I first started talking, we thought that it might be useful to address some immigration points with academy schools. I've done a fair bit of work with schools in the past, so I've got a somewhat of an understanding of what you have to deal with every day, although probably not to the same level of financial knowledge as my distinguished fellow analysts here. So forgive me for not knowing so much about the numbers, but I do know about the documents, so let's have a look at that. Not all of you will have overseas workers, but you will have employees. The point here is that you won't be able to get a statutory excuse. If you're doing a compliant right to work check, you get a statutory excuse. You can't get that now for these individuals. Okay. However, pre-settled status. So 2 statuses under the EU settlement scheme, pre and settled. People are not going to have to make a separate application for settled status anymore. So if you have got EU nationals, they've got pre-settled status under the EU settlement scheme, you've probably, hopefully, been tracking the expiry date of that pre-settled status in your systems. Actually, they're not going to have to make further application. It's going to be automatically extended for them. So if anybody comes to you, you're trying to do a follow-up right to work check on these individuals, bear in mind this has shifted quite a bit for those individuals as well. might not always seem so clear cut. They might not be able to generate a share code. Maybe the share code, the online check doesn't look as it should look. If that happens, seek advice, because pretty much all of them will have their status automatically extended or converted actually also to settled status in due course. Illegal working. Really hoping this doesn't apply to anybody in the room, but really important to note how important getting right to work checks are. The fines under the civil penalty scheme have been increased substantially to £45,000 for first illegal worker identified and £60,000 for each subsequent illegal worker. So when does this arise? It arises when we don't have compliant right to work checks and we therefore don't have a statutory excuse. It is that statutory excuse which protects us from these sorts of fines, as well as the other penalties that can go alongside illegal working identification. Ultimately, what we're looking for is conduct the right to work checks, make sure your processes are up to date internally. You've got robust systems, particularly where there's multiple sites, that everything is being done consistently and the correct record keeping is in place. But also that you have regular training, regular refreshes on this. It really is important to get it right. No right to work check, no compliant right to work check, no statutory excuse. If someone's presented a false document, you don't have a statutory excuse. It's a risk. It's a big risk. One thing that I would probably highlight is an area which a lot of people overlook, and it is the people that have visas that are not sponsored visas. So spouses, dependents of other people, and ancestry, etc. We'll talk about that in a moment. If you're not tracking those expiry dates correctly and robustly with regular reminders internally, they can get overlooked and missed. And I have lost count the number of times I have a client come to me and say, oh, their visa expired 3 months ago. Do we have a problem? And the answer is yes. So make sure that visa tracking element of your processes is really robust as well. Supplementary work may be something that comes across your desk, maybe not. It depends maybe how many part-time workers you need in the schools. But sponsored workers usually, they're sponsored as a skilled worker or something, but their work is tied to their sponsor, their primary employer. However, they are also allowed supplementary work. Okay, so they might come to you and say, I've got a skilled worker visa, and you might look at it and go, oh, you're not allowed to work for anybody else. Actually, they are. They're allowed to work up to 20 hours a week outside of their contracted hours for their main sponsor. Which is not quite a lot of time. And depending on what they're sponsored for, they might not be sponsored for a full-time job. They might be sponsored as a part-time job, which is entirely possible. So bookending 2 part-time jobs together. It used to be that the supplementary work had to be the same type of job as what they were sponsored to do. That's now not the case. It's much more liberal. They're able to do a much wider range of other jobs. And this is why it's more potentially relevant for you, in that actually somebody might be sponsored to do one type of job and actually might want to do part-time work in a school, and they would be allowed to do that. So bear that in mind for recruitment, bear that in mind for who might cross your desks as applying for work, because it could open up some opportunities for who you're allowed to hire. But just remember these points I've put at the bottom. And this was updated in the Right to Work guidance recently. If you are going to employ somebody who is on a skilled worker visa or some other sponsored visa, and we're relying on supplementary work provisions, there's some additional documents that you need to do and obtain as part of your right to work check. And the idea is basically that you're playing your part to make sure this person isn't just bookending lots and lots of supplementary work outside of their visa conditions. So it's more of a delegation of that monitoring element from the Home Office there. So you'll want to obtain some evidence of what their current sponsorship is, what the hours are, maybe the contract of employment might be useful. Confirmation that they are permitted to take on additional work, and also that they are maintaining that job, so they still remain sponsored. If they lose that primary sponsorship, they lose all right to work. And also that they confirm to you whether or not they're taking on any other supplementary work. If it does come up, take some advice if it's the first time you've done it, or maybe update your internal processes if it's something that you think might be frequent.
Next session now is with Alan to run through the budget forecast return, which I know a lot of you are really keen on, and lots of people have asked us for video, so no pressure, Alan. Over to you.
Welcome back, everyone. Yeah, I have got a very nice illustration which I think you've got the subject from the interest in this year's online budget forecast return form is now live. The deadline for submitting is the 29th of August. So, on the slide now, we have got lots of money, a piggy bank, maybe it's wishful thinking, but we thought we'd continue on the positive note. So just to give you a bit of background, I'm sure most of you are familiar with the VFR. Just part of the ESK's annual reporting cycle, and the process by which all of you have been to support their annual budgets to the ESK. I'll start by just talking a little bit about the structure of the form. Quite similar to the previous year, with a lower few changes. The main part of the return is broken down into the revenue budget and the capital budget, and each of those includes a section for income and expenditure. And this detailed part of the return covers the previous financial year, this current year ending in 23, and the next financial year. And each of those 3 years is analysed into 2 sections, a 7-month period to March and a 5-month period to August. And in addition to those detailed budgets, there's also a high-level summary budget which covers the current, the next financial year and the following 2 financial years. So a high-level 3-year budget. As in previous years, there's an Excel workbook which has been published to accompany the online form, so that can be quite useful if you're preparing to use that if you want to keep an audit trail, for example, where certain balances have come from TV, that kind of thing, and the same structure as the online form. Unlike the accounts return, we don't need to be involved in this process, but we can prepare like also complete the online form if you would like us to. One important thing to note this year is that the online form uses the new digitally sign-in registration service rather than the old system. Hopefully you've already got a login set up for that. If not, that's something to have a look at. If you would like us to be involved as the external preparer in return, there is a process for adding HWB into the online form, and it's quite a clunky process and requires you to approve us twice, effectively. Once to link us to the Academy Trust, and then once to authorise us for the budget forecast return external preparer. So just covering some of the changes in this year, so there's not too many, but most of the changes are in respect to expenditure. The ESK asked for more details regarding expenditure on IT and also building repairs. We've added, in fact, 7 different types of IT expenditure: connectivity, online on-site servers, IT learning resources, administration software and systems, laptops, desktops and tablets, other hardware and IT support. So all these new categories of IT expenditure. Of those seven, we've got several in the revenue, 5 of them also pop up in the capital section as well. So they've got a lot more detail in that. And all of those 7 areas haven't been all in the year's page of accounts until this morning, which we've now heard there's been some updates, and the new codes have been added to the chart of accounts to cover some of these areas. So perhaps that's a little bit putting the cart before the horse in terms of timing, but at least it's there now. So that's something to have a look at in terms of your accounting system, and use a separate budgeting system if it can cope with those extra codes with a different level of detail needed on that IT expenditure. The other change this year is there's also a separate line for building repairs and maintenance, building improvements. That's actually a disclosure payment line, similar to what we've seen in the depreciation. So those costs will still get reported as part of the normal non-staffing and non-IT expenditure. There's just a separate line to give the disclosure. That's the structure of the form. Of course, the main important part behind that are the numbers and the assumptions that sit behind those numbers. Very much the key part of the budget. As Michaela mentioned, it's the election year, lots of uncertainty. I thought we'd just have a look at the main areas looking at the income and expenditure movements. In terms of income, the main driver is very much the number involved. RFI says we need to be realistic and look at any trends in local information that's available, if feed schools, if that's relevant, and to get a realistic basis for that assumption. Obviously there's other income streams as well. This year we have a new pension grant which covers the 5% increase in the TPS from 1st of April. And this year the teachers' pay grant will be paid as an additional for merging into the National Funding Formula in the next financial year. Moving on to look at costs. Staff costs fall in the majority, and in terms of teaching staff, teachers' pay recommendations have been moved to the government but not yet published. So there's not a huge amount of information out there that may be published based on assumptions. So perhaps what's like the inflation or the increases that were last year to form a basis. And on non-teaching staff costs, recent increases we've seen as a fixed amount each pay point. Of course, that works out as a higher percentage at the bottom compared to the top. And this year, from the year to March 25, there's been a employed full and final offer, which is an increase of 1,290 on all of the pay points from 243 inclusive. And that works out as an increase of around 5.5% at the bottom, through to about 2.5% at the top. After that, again, we're not too sure, so we'll also look at a similar increase on inflation matters. And looking at non-staff costs, energy has been very difficult to estimate over recent years. Costs will very much vary from category depending on whether you have a fixed deal or how long it's due to run for. We've seen energy prices also well above the levels that we saw at the start of this current and energy prices. And then other general costs. We've seen at the moment projections that inflation is around 2% for the next 3 years. So that seems fairly consistent with this. So it's a very judgmental area.
It is investment policies. Another quick question. When was the last time you updated your investment policy? Is there actually a poll this one?
Is it just announce? Should you be able to just type in a year or?
How long ago? How many years ago? 1, 5? Is it longer than 5 years ago? Never? A real mixture.
Slightly nervous.
No, and let's be fair, when Michael Gove pushed the Academy programme out in 2010, rates were really low and it was not on people's priorities, so I completely understand that. That's excellent, thank you very much indeed. I'm going to upset everybody by walking around, but I can't sit still. The fact that I've sat still since 11 o'clock here is quite unusual for me. Thank you very much for the invitation to speak. I'm Ian Buss. My background is banking. I've spent the last probably 35 years working in the banking industry, with the last 2 or 3 years, crikey, it's nearly 5 years now, focused purely on the education sector through my own business. If I look historically, Lloyds Bank asked me to set up their education team back in 2010, which is when Michael Gove through the opportunity. And I built a team that ended up, by the time I left, looking after about 70% of all academies. So I'm guessing 7 in 10 of you here back with Lloyds. It's probably a fair guess, maybe more. And probably enjoying the free banking facilities that were put into the sector in 2010. So I've seen everything from the initial push by Michael Gove to get people to convert to SATs, to actually pushing that further and getting more SATs, and then the push towards MATs and the current push towards centralisation. I'm going to focus today on helping you to bring your investment policy up to date, because the list of nevers there is not unusual at all. And also give you some tools to think about a deposit strategy. What do you do with deposits if you're lucky enough to have reserves? Why? Why is that important? I got some data from the DFE on month-end cash balances August 2022. I don't think the 23 balances were out at the time, or they didn't want to send them to me. But at the end of August, and it's an important date, the end of the month, because your GAG funding comes in on the 1st, so this in theory is your low point. At that point, over 97% of trusts were either breaking even or had some kind of positive cash position and reserves. And actually across all trusts, the average balances were about 2.6 million. We'll have some people in here that say, quite we're nowhere near that. And we'll have some people in there saying, yeah, we're quite comfortably above that. But across the sector, across the academy trust sector, at the end of August 22, there was about £6.7 billion of cash sat in bank accounts and deposit accounts in the sector. That's a lot of money. So what are we going to touch on today? One of the biggest questions I come up from trustees is risk. Well, we set up our account with and we're comfortable with that. We don't want to talk to anybody else because we're concerned about the risk of other banks. We're going to touch on interest rates, what's happened, why now is something that we should be talking around in terms of getting your investments sorted out, and give you some tools to take away and then think, we probably do need to update our investment policy to create one. And we do have hopefully some tools then to help you create a strategy. And then we talk about other banks, using other banks. I suspect many of you have tried to open other bank accounts in your own right, and it's difficult, isn't it? Multiple applications, multiple ID and address verification, DNA, that kind of thing, or at least it feels like that. So I'm going to start by going backwards a little bit, go go back in time to 2006, 2007, 2008. 2006, everyone was happy. People were depositing with pretty much most banks, and then came along a problem. HSBC threw out a profit warning. In fact, they said they were going to lose about £50 million. And that's a decent amount of money for a bank like HSBC to say they were going to lose. And they said they were going to lose it because they had investments in the American subprime mortgage market. The mortgage market and the housing market in America pretty much collapsed. But a lot of banks bought packaged loans and thought they were going to make a lot of money on them. And as people were having their houses foreclosed on, these packaged investments were becoming worthless. And the credit markets took a look at this and thought, well, if HSBC are losing money, who else is going to be losing money? And they stopped lending other banks money. Not in its entirety, but they started to look at banks and say, well, we don't really know what you're up to, so we're not going to lend you the money. And if we look at Northern Rock, who can remember the queues outside of Northern Rock branches? It was horrific. People were queuing up thinking their money was going to go, because Northern Rock, like most banks and building societies in the UK, operated by borrowing money on the international money markets, the credit markets, on relatively short terms. So they would go to the credit markets and say, we need £500 million, please. And the credit markets would say, no problem, here's a 3-month loan for £500 million. Come back in 3 months and we'll renew it. And they were taking that money and lending it out in 25-year mortgages and buy-to-let schemes. So they were funding long-term loans with really short-term borrowing themselves. And as soon as the credit markets started making it more difficult for banks to borrow money that they weren't sure of, that's when they became liquid effectively. And that's what happened with Northern Rock. The government came and bailed them out. That carried on for a bit, and then we saw a major problem. Lehman Brothers, a big investment arm in America, go bust, and that spooked the credit markets even more, to the point whereby we had the RBS and the HBOS not being able to borrow money then on the international markets, and the government having to step in. What's really interesting is many of your trustees will look at this and say, that's one of the reasons we don't want to try a different bank. We're happy with the bank that we deposit with. Let's not rock the boat. And often that's based on the view that the banking system is regulated in the same way. But it's not. Post 2000, 2007, 2008, 2009, the regulator at the time, the FSA, was disbanded, and the government, the Bank of England, brought in PRA, FBC, and FCA. I'm not going to walk through the notes on the screen, but very basically, they were brought in to make sure the banking system didn't collapse again, to make sure that banks were regulated properly, to make sure that there was still the ability for customers to have choice and there was competition in the sector rather than just the big four banks. And they did that with a number of ways. Stress testing, you may have heard of. Basically, that took the bank's operating policies and ran through a stress environment. So if we had a major catastrophic event, would this bank survive? The interest rates, or really high interest rates, or a global pandemic. And actually, as a banking industry, we didn't see the collapse. They increased massively the capital requirements that the banks needed to keep, the money that the banks needed to keep on there. They needed to make sure they had cash, that if there was a run on capital, that they could withstand it. And they weren't allowed to borrow the same kind of amounts that they were, the same leverage that they were in previous money markets. And we've seen the global pandemic, we've seen interest rates nearly fall into negative, we've seen interest rates shoot through the roof again, war in Ukraine, energy costs going high, but we've not seen the UK bank collapse. The banks will tell you they think they're over-regulated. My personal view is, I think it's great because it's protecting the consumers. I use the word investment quite a lot. By using the word investment, I'm talking about cash deposits. I have come across a few trusts that have got non-cash-based investments. They tend to be where they've been gifted them. Davies Education Trust, for example. and they're allowed to keep that. But when we're talking investments, it's not something that you should probably go to the SFA and say, we'd actually like to open a share portfolio. I don't think you'll get permission. If you look at the trust handbook, there's non-contentious or repercussive transactions. You have to get the Secretary of State's okay. That's not going to happen generally. So stocks and shares, bonds, gilts, that kind of thing, I would never suggest a trust does that. If you've already got the historic code, that's down to you and your auditors to make sure you're comfortable with that. But I certainly wouldn't advise anybody to look at any kind of investment strategy that includes anything other than cash deposits. And based on the conversation we had earlier, probably short-term cash deposits, because I think it's quite difficult to go to the SFA and justify why you tied up cash for 5 years when the SFA really want to be spending money where they, in a relatively short period of time. I think the only time that would be acceptable is if you've got a project that you know you're going to be paying out money for in 2 or 4 years' time. So we are only looking at cash deposits today. What's happened with interest rates? We've sat there since 2008, 2009 on very, very low interest rates, which is why I'm not surprised that many of you haven't looked at investment strategies or investment policies for a few years or sometimes ever, because the vast majority of you, I suspect, started 2010, post-2010, in an environment where my interest rates haven't been very exciting for those wanting to put cash reserves. But the last year or so, it's been getting a lot more interesting. I'm seeing a lot more auditors saying at the bottom of the account saying, you've got quite a lot of money, you should probably do something about it rather than leave it in your current account. And I'm now getting quite a lot of auditors and accountants asking me to do this kind of presentation because there is good opportunity for trusts to enhance their returns and hopefully have something else in the income line of your budget forecast. Even your traditional high street bank are paying better rates than you would have got a year or so ago. So if you're not at the very least making use of your existing bank's products, that's worth having a look at. But if we go wider than the Lloyds, NatWest of this world, and keep it in the UK FCA regulated banks, there are significantly higher interest rates available. 4.35 for an easy access account. That's an account where you put money back within 5 working days. It's incredible. It's strong, really strong. That happens to be a Santander product. But it's, there are a huge amount of products out there from strong banks who are attracted to the sector and want to take their profits. So if you were lucky enough to have £1.5 million and you put this on deposit on an easy access account with that Santander product, you generate about £65,000 a year. That's just with the 1.5, so it's significantly less than the average position, but actually quite a nice little bit of additional interest to put in your budget forecast. And we'll only ever talk about UK FCA regulated banks. We're not talking about you going offshore or anything like that. And this is the bit that really gets me excited. If we go back to that £6.7 billion that the sector had on the 31st of August 2022, if 3/4 of that was put in an easy access account, i.e. you got to tidy up for a year, something that could get back within, you could get back within a few days, but still leaving 25% of that money in your current accounts, the sector could have earned over £380 million of interest. That's a staggering amount of money. The sector will have earned quite a lot of interest anyway, but that's me assuming that 75% of the cash that sat at the end of in bank accounts at the end of August 2022 was put onto an account now. So there's a share of that for everybody. So what stops us doing that? What stops us? Was it 96%, I think, of people just use their existing bank? What stops us using other banks at the moment? This is a bit where you talk as well.
It's the administrative burden, setting it all up and transferring money across and some capacity to
Administration, setting it up, absolutely, definitely. Anything else? What stops anyone else doing it?
Probably pay a bill.
Anti-money laundering, yeah, go back to it's bad enough opening an account for ourselves. When you go and tell a bank that actually we're an exempt charity, but we're also a company limited by guarantee, we're also a pseudo-government entity, that sends banks panicking a little bit from an AML point of view. So you're absolutely right. Anything else? Absolutely, making sure you've got enough cash. But I assume most of us here are FDs. The worst thing you can do is have your money tied up, and then on salary day, your salary not being paid. Your teachers won't be very happy with you. So you're absolutely right, budgeting, liquidity, you're not allowed to borrow, so that's absolutely critical. Generally, the reasons are the same wherever I go and whoever I speak to. It's the risk side of it. We only like the big four, and that sometimes comes from trustees. We're suspicious of higher rates. Why are they paying more than that one? How long it takes to open the account? Too time consuming to monitor that, get your deposits back, and we might need our cash quickly. Or our investment policy doesn't allow, or actually we don't have an investment policy, or it's too complicated. That tends to be the feedback that I get when I say, what's the thoughts on doing something, and why haven't we done something up until now? The fear side of it is very real. And that often comes from trustees that still look back at 2007 and 2008 and think nothing's changed. As a trustee, they're unlikely to have a significant amount of exposure to how banking regulations have changed, so it's completely natural for that. But it might be something that's worth giving them a little bit of insight into what's changed, if that's some of your trustees' reasoning. So I think from a to-do list, if that is one of the issues, I would absolutely just check the trustees, certainly the finance committees, understanding, and maybe the senior leadership teams, understanding of credit ratings, implied credit ratings, what the banking regulation looks like, and update your investment policy on the back of that. Which brings me on to investment policies. And I love investment policies because I would suggest 98% of the ones I've seen probably need some kind of tweaking. What makes a good investment policy? And again, I'd like to go back, perhaps read yours and see how yours compares to some of these statements. Most importantly, it needs to be specific and not open to interpretation, but also achievable. I'll give you some examples. I've seen investment policies where it says, we only invest in high street banks. On the face of it, we kind of know what the trustees are thinking about when they're saying that, but that is giving you a specific instruction. So you can't invest in Nationwide because they're a building society. And actually, when you've got the Bank of Abu Dhabi on a high street in London, does that mean you can do that one or not? Possibly, possibly not. Depends what they meant by that. I suspect not, but it's not clear. It's massively open to interpretation. What I would suggest you write on it would be something along the lines of, we will only invest in FCA, PRA regulated institutions that have a UK banking licence. Really clear, really specific, and you know it's regulated by the UK banking regime. I see this a lot. We only invest in safe banks with a good credit rating. Again, what does that mean? Because a good credit rating for you may be different to a good credit rating for you. What does that mean? We need to be specific again. Because if we're taking the investment policy the trustees have given you as FDs, it's your job to implement that. They've set the strategy, they've set the policy, it's your job to actually put that in motion. You might want to change that to something along the lines of, well, it has to have a credit rating or an implied credit rating that's investment grade at the time of deposit. Very simple, but very, very specific. We see some trusts that like to spread their money across banks. And a policy might turn around and say, well, deposits should be spread across banks to reduce the risk of loss if a bank collapses. What does the trustee mean by that? Does that mean spread across 2 banks, 22 banks? Again, it needs to be specific. Something along the lines of, we will not invest more than X million in any one institution. But make sure that's achievable. I had a trust once that had running balances of about £7 or £8 million, and their trustee said, right, we're not going to put any more than £85,000 with any one bank. Good luck with that, because that's going to be a real challenge, spreading £6.5 million across all different accounts of 85,000. Actually, your current account will always have more than 85,000, so you're probably going to breach that anyway. So have a look at something that's going to be sensible. The next thing is the liquidity, cash. You don't want to tie it up. You might need that money back. And I think a couple of you in the previous session said, we don't want to spend our reserves because we don't know what if. And the what if over the next 2 or 3 years. I think the ESFA gave some guidelines. So they said, we're not going to give you a specific amount that you should keep as in your reserves, but we would expect somewhere around 5%. So give it in one hand and then specify it in the other. So they would expect you to have probably somewhere around 5% anyway as a MAT. So if you're a £500 million MAT, that's very different to whether you're a 5 million turnover SAT. But that's the kind of figures that the ESFA would expect to see on there. But that doesn't mean it's sat in your current account, waiting to be used. It could easily be in one of those easy access ones that you can get back. So for those trusts that have always had, and this is a really common objection, those trusts that have always had cash flow questions, look at your previous cash flow. Look at cash flow forecasts and what is your just in case. I always say to any trust I work with, plot your month-end balances over the last 12 months. Again, your month-end balance is going to be your low point, because CAG funding comes in on the 1st. And it will look like that. I think we've got their figures alongside. They're kind of irrelevant. It doesn't matter whether that's 35 million, 3.5 million or 35,000. The concept is the same. You will always have bits that go up and down, and at the bottom there will always be a bit that doesn't really move. This helps you to start thinking about what could my deposit strategy look like if everything was easy to do. However poor our ability to cash flow forecast is with the all the lovely information the ESFA and DFE give us, we will submit something and we will hope. But that figure there is still, I like to call it an ocean of cash. It's really wavy on the top, but the debts don't move. That gives you then the ability to start thinking, well, actually, we know we've got X amount of pounds that we're not going to use for 6 months or 12 months because that's put aside for a particular project. We know that in 4 months' time we've got pay rises or IT equipment to renew, so we need that within 3-4 months' time. And actually the rest of it is kind of a just in case. That might be better sat in something that pays you 4% plus and being able to get it back, rather than sat in your current account and earning probably 0.01%. That's well worth doing when you get back to your trusts. And then the easy option is to stick it with your existing bank. But the interest rates are quite low, but you'll be getting more than probably just leaving it in your current account. Because the perceived challenges when you're using multiple banks are it's too time consuming, it's really difficult to monitor it, it's too complicated, the AML to open new accounts. And that's where platforms come in, cash deposit platforms. Cash deposit platform is a simple concept, and they've been around for probably about 12 or 13 years now. There are dozens of them. You might see them on Martin Lewis occasionally. You'll have the slides coming through. You might see them on Martin Lewis for personal customers, but they are also available for schools, charities, businesses as well. And the whole concept is you set them up once. You open up the platform with a single onboarding process. That gives you generally a hub account where you'll send money to from your bank account through the banking system. Once it's in there, you just go online and open and close and transact on as many deposits as you want to. Most of the deposit platforms will only allow you to do deposits, which reduces the AML you need to do, because the deposit platforms are linked back to your main bank account. So you have to send money from your main bank account, and when a withdrawal is done, it can go nowhere else but back to your main bank account, which solves, I think, the SFA's #1 fraud risk you mentioned earlier, which was mandate problems. This can't go anywhere else but back to your accounts. Once that's set up, it's there. Whether you use it or don't use it, it's available when you've got, whether it's a week or a year, to put some funds on. So I would look at cash platforms as an option. There, as I say, there are a number of them. You mentioned 2 earlier. They are all quite different. Some are more suited to the education sector than others. But they all tend to work on a very similar way. I'm not going to go through these slides because this session is normally quite a bit longer, but when you get your pack, it will show you an example deposit platform on how you can see all your different accounts, open new accounts, etc. So that's worth having a look. And the kind of investments or the rates you get from a deposit platform are significantly better than going directly to a bank. These are examples pulled from a deposit platform, all on A or A+ rated UK FCA regulated banks. Anything from 435 up to 531. That was at the 24th of May, those rates are still the same. We have a rate announcement on Thursday. Probably going to stay where they are, I would imagine. But so I don't see those changing a huge amount. And that gives you an example of, each million that's in there, how much you would earn if the money stayed there for the year and it didn't, and the rates didn't change. What I find quite interesting is how this does compare to your typical bank. I pulled Lloyds up here because Lloyds do have the biggest market share, and I've put their equivalent rates against equivalent banks with a similar rating on platforms, and gives you an idea of how much extra you could get using a platform. Obviously, platforms have different fees, and some platforms have higher fees than others. So that doesn't take into account fees, but you wouldn't be paying any more than 0.25% for a platform fee. What I found really interesting when I was doing this comparison is that there. Lloyds offer a 3-month fixed term deposit at 2%, but they also offer a 95-day deposit at 4%, both 3 months. Why are they so different? And this is where knowing the terms and conditions comes in quite helpful. If you put it in a 95-day notice account, Lloyds, and this isn't just Lloyds, but most banks, only need to give you 14 days to change the interest rate. 14 days notice. So as soon as they give you that notice, if you want your money out, you've still got to give them 95 days notice to get the money out. Whereas if you're on a fixed rate, it's fixed till the end of the term. So I always say to anyone that I've worked with, support, give ideas to, is if you are looking at an account with a notice period in an environment where we're expecting interest rates to reduce, just check the terms and conditions, because you don't want to be stuck with that and still having 2.5 months notice to give, and they've dropped the rate to 1.8% instead of 4%. And that's worth reminding the types of deposits. Easy access, no notice. Rates are variable, you can get the funds back. Generally, because it's with a different bank, it can take up to 5 working days. But most of us can cope with a 5-day notice to spend money. Notice account, you cannot, under any circumstances, take money out early. Pre-2007, 2008, banks could let you do anything, but they're not allowed to anymore. But their rates are variable, and the terms and conditions can make sure that they tend to be in the favour of the bank. Fixed terms, again, you cannot, come hell or high water, take the money out early, but at least you know exactly what you're getting by the end of the period. If you are sat with more than £750,000 at the end of the month, on average, it's worth doing something. So I would recommend that if you're not achieving anywhere near 4% on the bulk of that, have a look at your deposit strategy. And get the understanding of your SLT and your trustees. Do they understand what's happened in the banking regulation environment post-2007, 2008? And assuming they're okay with that, great, update your investment policy. And then review your deposit strategy and options. If any of you want the draft investment policy, since I've been doing this for the last 4.5, 5 years, I've probably created about 100 investment policies. It's now boiled down to, actually, they are all pretty much the same. So I'm very happy to share that with you, and then you can use that for either as is or tweak it. Equally, if any of your trustees want talking through what's happened with him, or you want further information on what's happened with the investments strategies, or what's happened with the banking regulations, always happy to have a chat.